Thank you very much indeed for turning up this evening. Clearly, we're a welcome distraction from the Euros. And for those of you who don't know me, I am Donald Leggett, Head of Investor Relations at London South East, and I'm your host for this evening. We choose our event dates months and months in advance, of course, and I'm sincerely grateful England aren't playing the semi-final tonight. As you can see, we have a broad range of companies and sectors for you this evening, starting with two very different gold companies. Caledonia Mining Corporation is the owner and operator of an active gold mine in Zimbabwe and announced record production and indeed increased the dividend again this morning. Q3 results were out this morning, whereas Aurosur Mining is an explorer developer in Colombia, working in a 50-50 JV with two of the world's largest gold miners, Newmont Corporation and Agnico. Together, they're developing what is increasingly looking like a tier 1 gold mine in Colombia. Moving on, Tekcapital has a portfolio of 4 companies, all with considerable intellectual property, addressing billion-dollar-plus markets, each and every one of them, and meeting unmet needs in those markets. Our 4th company is Glantus Holdings. They specialize in automated accounts payables, and they work with larger corporations. The CEO comes from County Cork, and it has sufficient funds to build the business by acquisition, as well as by organic growth and partnerships. As usual, our CEOs get 20 minutes to present their investment case. Then we take questions from the audience for a further 10 minutes. Please use the Q&A button at the bottom right of the screen, not chat, as we've disabled the chat function. Please keep your questions short and understandable, and give us your name so that I can give you a mention and say thank you. We generally get a very high number of quality questions, so please do send us your questions as soon as you can. Our moderated chat boards are one of the best loved parts of the website, the lsa.co.uk website. So please do consider posting your messages there through the evening. There are lots of people who can't make it tonight, and I know they very much appreciate it. Finally, let me tell you about our future events, a short plug for us. I think August will be a holiday month for many this year. It's not been the kindest of years. And we're back on Tuesday, the 7th of September, and again on Tuesday, the 19th of October, and again on Tuesday, the 7th of December. So some dates for the diary there. That's it for the housekeeping. Time for Orosur Mining. We start the evening with Orosur Mining, listed on AIM and TSX, and a favourite with London South East investors. I know that many of you have turned up tonight to see them, and they're on a very exciting journey. Orosur owns 100% of the Anza project in Colombia, which has the potential to be a tier 1 gold mine. OMI have a 50-50 joint venture at Anza with two of the giants of the gold industry, Newmont Corporation and Agnico Eagle Mines. And Newmont and Agnico are paying for the current drilling operation, which is almost ended there. This morning's RNS almost doubled the market cap. It's up to 46 million. The share price was up 99% at one point and ended the day, the close of day, it was 83% up. We are delighted to have Brad George, the Aurosur CEO, join us live from Perth, Australia, to put this morning's RNS release into context, no doubt. So welcome, George. If you could share your slides with us, please, Brad.
Okay, well, I'll just figure out how to do that.
There you go, looking good. As you can, yeah.
Pardon my lack of technical skills. So
you're forgiven, Brad.
All right. Well, morning, Donald. It's 1 a.m. So I do enjoy these early mornings. I guess firstly an apology, which is always a mistake, for the 11th hour announcement this morning. It's entirely my fault. We need to circulate our announcements to a fairly wide range of people, JV partners and regulators. And I had completely failed to recognise that we had the 4th of July, Canada Day, and a public holiday in Colombia over the last 4 days. So we had a bit of an all-nighter last night to get this out in time. The presentation today, it's the first half is going to be a rehash of older slides, I guess, for those who maybe have come in recently and missed the last presentation. I'll try to run through those quite quickly and get to the interesting stuff toward the end on where we are and where we're going. Usual disclaimers, which we all have but nobody reads. This snapshot clearly, I haven't updated it today. The share price had a bit of an exciting day, so we'll update that moving forward. The two key points here, of course, are we're a reasonably small company in terms of shares on issue, 188 million. And the cash on hand is still hovering about $6 million US, courtesy of a capital raising late last year and subsequent exercising of some warrants. And I can only presume with the share price run today, we might get a few more of those exercised over the next couple of days. So that keeps us in a nice, healthy position. And of course, as Donald mentioned, Agnico and Newmont are paying for the bills in Colombia. So that's not being drained down terribly quickly. This is the last time I'll show this slide. Obviously, our history is long, mostly in Uruguay. We've had 20 years running a mine in Uruguay, 1.5 million ounces, and that came to natural end of its life in 2018. And we're at the late stages now, winding that up. So it's coming very close now. That's probably the end of this year. We'll have that largely off the books and done and dusted. And we will be exclusively then a Colombian company. So it's been a fairly rough journey, that transition with that mine winding down, but it's largely done now. And all of the uncertainty attached to that process has largely been washed away now. Just some nice, pretty pictures. Clearly, this is no country for old men, or in my case, old fat men. So I need to get into shape for when I'm allowed to travel again at the end of this year. So it's a lovely country, but it's not for the faint of heart. The Mid-Cauca Belt in northwest Colombia is, for some time now, began to show itself as a fairly major gold province. We have some very large projects here. Buritica to the north of us is one that came on stream production-wise beginning of this year. It's over 10 million ounces and lots more to come from there. Probably the most notable exploration project is Los Cerros south of us. They've been doing some very nice intersections over the last couple of months. There's a lot going on, and we're just adding to what is becoming a quite exciting story for this part of the world. Quick snapshot of our lease holdings. The green leases are granted tenements. The red are applications that remain to be granted. I'll use my little mouse here. So the Aptar deposit where we're drilling is this little bunch of leases in the middle here, with the Aragon fault running up from the south to the north. These two main applications are our focus on being granted hopefully this year or early next year. We're pushing those forward, but there are some issues there with largely COVID-related delays in the admin process. Total area of about 200 square kilometres, so it's a nice land package. The joint venture with Agnico and Newmont is a fairly complicated one. It extends over 12 years, over which time they would be required to spend $26 million and make cash payments to us of $4 million, giving them a pathway to move to a total equity position of 75% in the project, not in the company. We're coming now to the end of the third year, so really only just beginning. Excuse me. The anniversary date is 7th September, where Agnico and Newmont would be required to make a decision to roll over into year 4. That hasn't been made yet. That's entirely their decision, but I would imagine, given the recent results, that's likely to continue. Just some regional geology. We're at the eastern side of the Andes, so we're in what we refer to as a back arc basin behind the Andean Cordillera. A large sequence of volcanics and sediments and north-south structures, along which most of these major deposits are being found. Buritica obviously being directly along strike, about 50 kilometres away. So we're in the right location, which always helps. Locally, we, as I've commented before, we're still getting our heads around what's going on here. This is certainly the gold phase is very much an epithermal gold project, but we're seeing evidence of an older volcanogenic massive sulfide deposit, which is some base metals. Age-wise, these are very young. We're looking at the gold events that are only 5 to 8 million years ago, so it's really only yesterday in geological time. So, which is a nice situation to be in terms of the rock still being fresh and fairly easy to work with. We have a major structural corridor running north-south, which is the Tenochco fault, but it's this subsidiary structure running up here, the Aragon fault, that we think is the major driver and the major host of exploration. We have a series of volcanics off to the east, some sediments, and this major breccia package in the middle that has filled out the Aragon fault zone as a major host of exploration. We have what we think is a fairly large porphyry intrusion here north at La Sasita, which we postulate might be the fluid and the heat source for all of this, but that's yet to be determined. The question we've been asked in the past is where this project has been. It's had a long, somewhat checkered history. We acquired the project in 2014 via the acquisition of a Canadian company, Waymar Resources. They had previously done quite a lot of drilling. They had also done some work with Anglo-Americans, some sampling in the region, but they basically ran out of money in a period of time when the markets were then closed to mining in Canada. Aurosur did a very small drilling program in 16-17, but then Aurosur, sadly, in hindsight, became financially stressed as the Uruguay mine was winding down, and therefore the project really sat on the back burner. We simply couldn't afford to run the project, which is where Newmont came in late 2018. Sadly, almost to the day that JV was signed, there was security issues in Colombia. There was some issue with some geologists at Buritica, and Newmont backed away for security reasons. So very little was done, and it all kicked off again late last year with the entry of Agnico into the project in October, and then the commencement of drilling in November. So the share price really kicked off with Agnico coming into the party. I've shown this slide a few times, and I'll probably show it a few more times, and it illustrates the problem and the opportunity that we've got with the previous drilling. Waymar, the previous owners, did a lot of drilling. They did 18,000 meters, which seems a lot, but almost exclusively they drilled in the wrong direction, which is slightly annoying, but there you go. And while these holes were on paper very interesting, and they gave very long intersections of high grade, geologically they're almost useless. They told us nothing about the geology, and they're even less than useful when it came to calculating a resource. We had to really turn everything around and drill from the other side and drill toward the west to understand the continuity from hole to hole. So it was a nice batch of drill holes to have, in the sense that it told us where the gold was, but we had to go back and almost repeat everything to get the information geologically to allow us to develop resources. So a good problem, but there's the opportunity. To the results today, I won't go into them in huge detail. The markets obviously enjoyed them. There's not a lot to say about holes of 60 meters at 10 grams. You don't get those very often. I certainly haven't in my life, so it's nice to get a few in before I retire. But very interesting. It's both thick and it's high grade, which are the two things you really want to get. We've released 9 holes today. That's 19 to date, up to MAP 091. We're currently drilling 095, and we would expect those assays to be coming in weeks and months, but sadly the assay delays continue. As we noted, we did at one point have 5 drill rigs running. We've now reduced to 1. That's not an indictment of the project. That is simply what the plan was. We had a plan of 9,500 meters. We brought in enough rigs to enable us to do that program in the time that we wanted, and now we're coming to the end. We can reduce to 1 rig and move at a more steady pace. We now are getting to the point where we can begin to develop 3D models around this, which is where things get interesting. The drilling was designed to address certain questions geologically. They've been largely addressed, and now we're beginning to wrap some numbers around some resource and tonnages here. I'd also note that the base metals still remain extremely high. We didn't announce these, but they were small intersections, but we had in spot zinc up to 30% odd, 4% lead, and a couple of % copper. So that comes back to the overprint of the recent gold upon the previous base metals deposit. There's a reasonably good correlation that the two inhabit the same space, but there's not a one-to-one correlation between gold and base metal grades. That's a very nice sweetener and something we need to examine in future, that's going to make a big impact in economics. But for the moment, it remains a gold project with the base metals being a problem for tomorrow, a nice problem to have for tomorrow. The recent drilling has certainly changed our understanding of what's happening to a certain extent. We got a bit carried away with our first hole back at the beginning of the year, thinking it was going to be easy. That served us right. What we're now finding is that the main fault region of the Aragon fault plain is mineralized to a low level, but then every now and then it blows open to these large pods of very thick, very high grade mineralization. Now, this is not unusual. This is sort of the way things work. I don't want to give you a lesson in structural geology because I'd fail, but we need to understand the structural controls that are driving these major blowouts, because these things are where the money is. From a mining point of view and from a tonnage point of view, the ounces and the dollars are in these big, thick, high-grade pods. And so we need to define where these go and how big they are. And the bits in between are the cream on the cake, but the money is in these pods. So we need to focus drilling now on defining these chutes. Now, why they exist, I guess, is a point still to be determined, but it's a reasonably accepted rule that these gold-bearing faults are not mineralized along their entire length. Otherwise, we would be dripping in gold. It tends to be where the structures bend, and they can bend for all kinds of reasons. They might be wrapping around a granite, or there might be intersections of several faults, but it's where these structures bend, and then we get movement along that fault. And the movement and the deviation of the fault pops open these dilation zones, a dilational jog or whatever term you want to use. It pops open these open spaces into which the gold-bearing fluids then flow. So it's understanding both on a macro and a micro scale, because geology tends to be quite fractal, where the major deviations in the fault are and where these dilation zones have popped open. And those are the areas we focus on with our drilling. I will also point out that these pods we've got here, these are not complete. These have not incorporated the recent drilling. And we've got a couple of holes that are currently underway in here that hopefully will fill this gap in. So this is a couple of weeks old, but it will be infilled in coming weeks. This is probably the most important slide from a takeaway, that of what happens next. And that question really is one of, depends who's asking and depends who's being asked. This red model here is an attempt at us to do a three-dimensional resource model on the northern half of APTA. The southern half down here hasn't been done yet. We've still got a few more holes coming in. So we as a company and Agnico as well, we certainly have the ability now to develop models of the mineralization of this, dare I call it an ore body, to give ourselves some idea of tons and grade, but we can't tell you about it. This is purely for internal consumption. We obviously are prohibited from mentioning this to the market, or mentioning numbers to the market, unless they become 43-101 compliant. The question is, do we want to do that? And the answer at the moment is no. And that's not because of it's a bad idea, it's because it's not our decision. Now, this is a combination of issues to do with timing, planning, and the issues with the laboratory. The main driver for the drill program we had was to give Agnico and Newmont enough information about APTA to allow them to come to the decision point about now, where they could roll over to the fourth year of the JV. So as I mentioned, that begins in September. So they need to be making decisions now whether they wish to commit another $4 million next year. So they needed to get enough drilling done by a certain point in time to make themselves sufficiently comfortable to move forward. So we've come to that point now, and they're presumably having their assessments. The other problem we face, of course, is the delays, the ongoing delays from the assay labs in Peru, where we are at a point, and have been at a point for a while now, where it's taking us twice as long to get assays as it takes to drill the hole. Now, it doesn't take a mathematical genius to realise that that's not sustainable, that every day we drill, we're falling further behind. So we pushed that as far as we could with the 5 rigs running, but we've now reached a point where there are thousands of samples in the lab. We really can't continue because we're beginning to, it's getting expensive. Obviously, the holes released this morning, there were some very good holes, but clearly there were some less good holes. But that's how exploration goes. But with every hole costing between $50,000 and $70,000, we do really want to improve our hit to miss ratio somewhat by having a little bit better targeting. So we need to wind back to 1 rig, allow the lab to catch up, so that we have a little more information in our hands for positioning each hole. The other point I would make, of course, is that we're just coming out of wet season. And so drilling at Aptar, where we have good access, good roads and a good camp, was a good place to be during the rainy season. The wet season's just ended, so we can now get guys into the field in more remote regions. So the seasons do play a part. So in terms of, do we convert this to a resource? Well, if this was just an Aurosur project and it was our money, I think the answer will probably be yes. We probably would stay here and drill this to a resource, because as a small single asset company, having a JORC or 41 resource would be a good underpinning for our valuation. That's not our money. Agnico and Newmont are paying the bills, and so they therefore drive the strategy. And they don't really care about resources. They, as 2 combined companies, they're sitting on a resource basis of 150 million ounces. So a couple of million more ounces here is of no interest and no impact on their share price. And therefore they have no incentive to move this to a resource. What they want to know is, what is the ultimate potential of the entire Anzá project? So their thinking presumably is going to be, well, we know Aptar now is interesting. Let's continue drilling that slowly, but we can, to a large extent now, just sit it aside for a while. And now that the rains have stopped, head up and down strike of the Aragon fault and look for more of these things to get a sense of what the ultimate endowment potential is, and then come back and move these things through. And we may well find, of course, that this is not the best one. We may find more of these things, we might find better ones. So their view is to now step back and look at the wider potential. And I'd also make the point that we've now drilled, well, we and Waymar in the past now have drilled about 33,000 metres. Buriticá in the north have drilled over 350,000 metres. So we're really only beginning this game. This is a nice little satellite image of the digital terrain. So this is the mountains and valleys. One of the beauties of these young rocks and this rugged terrain is you can actually see the faults, because the faults show up in the terrain. The rivers and creeks exploit these faults, and so we can see nicely, if you can see my cursor, the Aragon fault running up here from the south. We have a major bend here at Aptar, not coincidentally, where we're seeing the Aptar mineralization coming up. It then bends into this license, another big bend, and then trundles nicely up to the north and a few more little bends. And then we have subsidiary structures coming off here, parallel structures running down here and here. So we're able to know where to go, and in the sense that we know where the structure goes in a general sense, and that helps us focus our field work somewhat significantly. We're not wandering the bush blind. We know pretty much exactly where to go. So this is the wider region and some new prospects that we've developed over the last couple of months. As I noted previously, the Aptar project was drilled by us and by Waymar, not because it was the best, because it was the one that we could get at the easiest. There was an old historical gypsum mine over the top of Aptar. And as a result, there was some tracks and pads and clearing. So it was an easy place to get at. These areas to the north and to the south have never been touched. The access is poor. We're getting into them now on the backs of horses and trekking in with backpacks. So really, we have no idea what's happening up here. We're looking at a few new prospects. We have Pepino here, that's recently been named, and Pepas to the north, so you'll probably hear more about those in the future. The Charascala prospect, there was a few holes still there a few years ago. Interesting, but not our main issue. The Guaymarala prospect, south down strike along from Aptar, is very exciting. That's more of a land access issue, so we're in negotiation now with the landowners, and that's going well. We want to be working there reasonably soon. Jesuitas is the one that I find quite exciting, because this is where we see this major bend in the structure. This, however, is not yet granted. So while we can do mapping and sampling and geophysics there, we can't drill until that's granted. So that's more end of this year or later next year.
Okay, you've got a couple more minutes, please, Brad. A couple more minutes.
And to the south here, we'll do some more work as well. Right. The sampling isn't just wandering around. This is all owned land, farmland. So we do need to understand who owns the land, talk to the farmers. Obviously, these pictures down here, the wet season can make this rather exciting. We've had a few geos washed away, but we did get them back. So that was fun. But what we're seeing is very interesting. We know there's a major fault here, and getting into the field, we find what we expect to find where we expect to find it. So we're seeing quartz veins, we're seeing sulfides, we're seeing all the right kind of stuff up and down along strikes. So it's nice when you go look something and you find it, and we'll look at getting in here in the very near term to do more work. Geophysics is next. Drilling to the north is expensive due to the need to build access, and so therefore we're going to start with some induced polarization surveys first. Because we have a very good correlation of high sulfides with gold, IP should work well. So this is a very fast and moderately cheap way of giving us some direct drill targets before we then bite the bullet and get into those areas with the drilling. The drilling, as I said, will be expensive with tracks and even chopper support. So we do the easy stuff first. So where does that leave us? I'm conscious of the time. So we're going to keep drilling. One rig is at Aptar, and that will stay there and slowly grind away, focusing on these high-grade shoots. So there'll be hopefully good news flow coming out of that. The major milestone we face is the rollover of the JV beginning of September. That obviously is beyond my control. Agnico and Newmont will make their assessments and inform us in due time. I'm sure we'll be the last to know. But I would be quietly confident that they will roll over, but that will happen obviously in August. We'll continue mapping and sampling, and we'll be releasing geochemical results from those programs in coming weeks as the laboratories in Peru and Colorado bring those forward. The IP surveys commence the end of this month, beginning of August. That's again a wet season issue. You don't do IP surveys in the middle of rain because you're going to kill somebody. So that's the wet season issue. And then we'll be releasing those results as they come in over the next couple of months, with a view that with access and targets, we can commence drilling on new targets in that northeastern area, October, November this year, with a view that moving into next year, we will have, or hopefully have, 2, 3 or 4 targets, with a couple of those being drilled at any one time, but with Aptar, I guess, being the most advanced and moving forward. So it's an interesting time, lots to do, and it's a nice situation to be drilling one high-grade target and a couple of things that might hopefully be similar. So I do thank you for your time.
Excellent. So is it time for you and me, Brad?
I always have time for you, Donald.
Fantastic. Shall we do some Q&A?
Well, I'm awake, so you might as well.
Okay, my first question, Newmont Agnico are looking for a large, I think it's a 5 million ounce gold project. So a really, really, really large project. And what's their exploration strategy to achieve that?
The actual size limit will depend. I mean, Agnico is a smaller company, so they can probably get away with maybe 3, but Newmont, they need to deal with things that are 5, 6, 7 million ounces. So we know there's no shortcuts here. The evidence of Aptar tells us that this is a fertile system. So we know that the gold is there. We know we're seeing high grade, we're seeing thick, we're seeing all the right things that tell us that this is a very interesting place to be, and that we've got 20 kilometers of a major structure that is essentially untouched. So we just grind along. We get into the bush and we walk along this structure and we find the areas that we look interesting. We do the geochemistry, we do the geophysics, and we drill. So it's not rocket science. It's just hard work.
How much of that 5, 6, 7, or 3, depending on which of the companies it is, how much of it is actually has already been found and discovered and being explored by you in APTA?
Well, obviously, I'm not going to tell you a number on APTA because, as I mentioned, that's falling into the compliance bag with 101. But to give you can do the you can do the numbers. If you start getting 10 grams a ton over any kind of width, then you accumulate ounces very, very fast. And this is what made Buritica a very attractive project. 1 million ounces at those kind of grades fits into a block of ground only a couple of 100 meters long. So I'm not going to speculate about numbers because that's one, I don't know, and two, I really can't be saying. But I would say we certainly have made a pretty good start to moving toward a multi-million ounce field.
Okay, thank you very much indeed for telling us what you can. And what about the $4 million of exploration money, year 4? You said you weren't sure, or you said you were fairly sure that was going to happen. Actually, is that fair enough? September they have to.
Yes, well, I don't speak on their behalf. So I mean, they will make their decisions in their own time and their own way, and they'll inform us when the time comes. So we know what data we've acquired to allow them to assess that. That's the drilling has been done. We're still waiting on the geochemistry and the more regional leg sampling. So I'm not going to put my hand in the heart and say, yes, they're going to roll over. But I would say if I was a betting man, it would be very hard to walk away from 60 meters at 10 grams.
And they have already, you on their behalf, have already started exploring, part of their strategy, looking for new APTAs. Yes,
I mean, it's a slightly odd hybrid arrangement in that we do the work, but they pay for it. Now, there have been comments about that they do have the right to assume operational control. Now, that's something that they may or may not do, but that to me is not the main issue because I commented in the past, it won't change much. It'll make my life easier, but it won't change much on the ground. The same people do the same job. They'll just be wearing a different shirt. So I think they probably will, but if they didn't, then I wouldn't be surprised because, well, the project's been run well. So why make your life even harder by stepping in and doing all the miserable work? So look, I'm confident, but that's very much a wait and see thing for the market. I'm sorry.
Okay. What about the lab in Lima? The delays are continuing. Is there anything you can do to speed up the delivery of these assays?
Sadly not. The first assay problem we experienced was just labour due to the first burst of COVID beginning of this year. But then it came down to, oddly enough, argon gas. We do fire assay for gold, and we do ICP-MS for base metals. The P stands for plasma. It's an argon plasma. And sadly, with the major surge in Peru over the last few months, the government quite reasonably told all the gas manufacturers to re-gear toward making medical oxygen. So there was no argon forever. So that's becoming relaxed now, and the problem's to a degree going away. But as a result, there's now a huge backlog. So yes, it's being corrected, but it's not being corrected today. It'll be over the next few weeks. It'll begin to improve, we hope. But sadly, no, we can't impact on that at all.
Okay, let's go to the Agnico having the right to assume control of the project. Do you have a sense of that, and what would they do, and what would it mean? And I
think they would like to, because they would then not have to deal with me, and I'm a fairly annoying git. So I think they do. And
how much would they have to pay for that? What would the price be?
Oh, zero. They just assume control as and when they want to. But they will take all of our staff and they will become Agnico Newmont staff or the local company that they formed, Minera Aguila. So it's not a difficult transition.
What do the OMI shareholders get out of that?
Nothing really. The same things will happen. The same things go on by the same people. The same drilling goes on. The information flow remains. So really, there's nothing at all that impacts on Aurosur other than me not having to do monthly reports. So it's a very small change. In fact, it's almost insignificant change in terms of Aurosur. So I wouldn't put a lot of stress onto that.
Okay.
One of the issues.
What about if they actually buy you out? So say in several years' time they decide to buy you out. What's your take on that, and how do you actually maximise the benefit to shareholders in that?
Well, we're not for sale. Well, I'm saying we're not for sale. It isn't my decision. We again have no control. I doubt they would. I mean, they have what they want. They have a pathway to move this through to 75%, so they can sit back and take their time. You know, should a monster be found and they want to get rid of us, then that's entirely their call. The only thing we can do is to make sure, which is what we have done, is to make sure that we have the balance sheet strength to make them pay as high a price as possible. You don't want to be in a position where you're running out of cash and you're sitting on a big asset. So all we can do is just make ourselves a hard target.
Okay, so the whole idea is to keep your balance sheet healthy.
Yeah.
Okay, Andrew Robson asks the very valid point. Do you anticipate COVID causing disruption to operations? Well, you've just told us COVID already, lack of argon is disrupting operations. What else is happening with COVID?
Well, COVID is still there. Colombia's having a very, they're a bit like Australia, and they're very slow or somewhat slow to begin vaccination, but they're ramping up quite aggressively now. So COVID is relaxing and we will hopefully see the impact of the vaccination program flowing through to the numbers over the next couple of weeks and months. So we think we're past the worst of it. We've survived this far. We've had a few little scares and a few little cases here and there, but we clamped down quite quickly. So we've done a good job to this point. And now I think with the dry season coming in, COVID not falling away, but certainly becoming less of an issue, we're quite comfortable now that we're moving into a slightly easier time. So hopefully, fingers crossed, the COVID thing is not gone, but going.
Okay, fantastic. Now let me conjoin two questions. Nathan Peters asks a couple of questions. He wishes that the board had more than 1% of the shares in issue. And the second point is he wishes communications with retail shareholders were better, more use of Twitter, more pictures from the site, etc. So what are your thoughts on those two? That's my final question.
Yeah, I wish I owned more shares as well. But in terms of director buying shares, one, I'm not rich, would that I were. But the primary issue there is that when you're drilling, it's almost impossible not to be in possession of information that's market sensitive. It just doesn't happen. Now, from the day I joined the company, I knew stuff that meant I couldn't trade. And there were a few little gaps here and there that we could. But when you're drilling, you just can't do it. I mean, as soon as I get a WhatsApp text from my geo saying they hit something sparkly, I'm off the board. So really, until the drill rig stopped turning, it's almost impossible for us to be buying, sadly. In terms of communication, well, yeah, that's always an interesting problem. It's never enough or it's too much. Again, you know, we have made a decision to run the company in a very conservative way, and we're not going to change from that. We don't want to be seen as a company that's promoting simply for the sake of promotion. We want the results and the project to speak for itself. So we will communicate with the market in a very rigid way based upon results, with maybe the odd commentary here and there. And hopefully once COVID's gone, I can travel, then we'll do some more face-to-face stuff. But I'm not going to fall in the trap of simply tweeting every day because people want some sort of clickbait. Once the results are there, we'll move forward. And I would hope that with the increased activity in the more regional areas, in conjunction with the drilling we're going to carry on Aptar, there will be more happening anyway. So hopefully there'll be a natural progression to more information flow just as we get busier. So, and that may keep them happy. But to simply tweet for tweeting's sake is not my thing. Sorry. Okay,
Brad, you've got up. You're speaking to us in the middle of the night from Perth, Australia. I can't thank you enough. Thank you so much for spending the time and literally drilling down, as you might say, on your operations for us. You're a complete star. Thank you so much.
Always a pleasure.
Okay, up next, it's Caledonia Mining Corporation. So, Mark, yeah, here we go. Let me do your introduction and you can start sharing your slides as you go. Our next AIM and NYSE listed company is Caledonia Mining Corporation, who holds 64% of the Blanket gold mine in Zimbabwe. And they also have 2 exploration projects in the country. After 5 years and $67 million, Caledonia have successfully completed a new 1,200-meter shaft, which is now in operation. Numbers announced today, Q3 numbers today, show that gold production hit a new high this quarter with a target of 67,000 ounces for 2021 and a new target of 80,000 ounces by 2022. CMCL pay a rising quarterly dividend, which is now 13 cents a share. The news boosted the share price up 6% today, and that pushed the market cap up to £117 million. Mark Learmonth, the Chief Financial Officer, is joining us from London tonight. Welcome, Mark.
Good, thank you, Donald. Well, let me just quickly run through this. There's the disclaimer. So we've really got our strategies focused on four bases. The central shaft, which is this project that we've been building now for 7 years or so, and we've just finished, and that really gives you near-term, low-risk growth, which will drive a significant increase in production. So in 2020, we did about 58,000 ounces, as Donald's already said. This year, we're looking at sort of in the mid-60s, and from 2022 onwards, about 80,000 ounces. So, I mean, that's baked in. We've got the infrastructure, we've got the resources. It's just a question of just linking it all together and making it work. Over the past 7 or 8 years or so, but increasingly, especially over the past 2 years, we've demonstrated a real commitment to return money to shareholders. We've consistently paid a quarterly dividend for many years now. And as Donald said this morning, we did our 6th dividend increase in the last 2 years. And as well as the existing project in Zimbabwe, we're now beginning to look at new opportunities in Zimbabwe, for which we have the funds that we're generating, which we can then deploy some of that funds into these projects. So just by way of an overview, we're an established, profitable gold producer with an expanding production from what's called the Blanket mine, which is in Gwanda in the far south of Zimbabwe. In addition, we have two option agreements, 2 exploration option agreements over Gweru, over 2 properties in the Gweru area in the Midlands, and they've historically been very, very productive for gold. So we're cautiously optimistic about those. We're no longer. A lot of people still think that we're a Canadian company. We're not. We're domiciled in Jersey and the Channel Islands, which is important because it means that it's a tax-neutral jurisdiction, so we don't incur pesky Canadian taxes and English taxes, even though we've got no business in Canada or England. And in particular, it means our dividends don't incur withholding tax. We had healthy cash. We had about 16.3 million in cash at the end of April 2021, and we're on a P of about 7 times. Last year's revenue was about 100 million, and as I've said, our production guidance this year is between sort of 61 and 67,000 ounces. And you can see our historic and our forecast production in that bar chart on the right. We've got just under 1 million ounces of M&I resources, just less than 3.3 grams a ton, and inferred resources of about just less than 900,000 ounces. And we've always had a 100% conversion ratio from inferred to M&I. And it's fair to say that over the past sort of 3 or 4 years, because we've had logistical constraints at the mine, we've not been able to do further deep level exploration. So as soon as the central shaft is now operational, we'll be able to begin doing some more deep level exploration. We've got a 13-year life of mine. Here's the dividend chart. So we've been paying 6 and 7/8 cents per share per quarter for many years now, and then we started to increase it early in 2020. We would probably have increased it again in April 2020, but frankly, with the onset of COVID, even though it had no actual effect on the business, we just felt it inappropriate to increase the dividend at that time. And then thereafter, we've continued to increase the dividend at about 1 cent per quarter. I think that yield's probably out of date now. I think the yield's probably about 4%. Our share price, as you've seen, has come down a bit. But it's a reasonably healthy yield, and as you'll see, we have plenty of potential to continue to increase the dividend payments. This is our share price graph. Shot ahead in mid-2020 as we were included in the Russell 3000 index, which gave rise to some very exuberant buying, particularly in North America. And at that, when our share price hit a peak of about $27 a share, that implied a discount rate of 1%. future cash flows, which is clearly overdoing it a bit for a single asset Zimbabwean producer. The share price has come down. It now seems to have settled at about $13 or just under £10 a share, and that reflects a discount rate of about 20% on our forecasts on our future cash flows, which again I think puts us into oversold territory. Management and directors have got about 4%. Most of that is myself and the chief executive. And Alan Gray is a very substantial South African institutional fund manager. They're our next biggest shareholder. Some of these other shareholders have actually recently moved off. So from there, some of these shareholders may have adjusted slightly as a result of the Russell 3000 rebalancing. But we've got a Liechtenstein-based private client investor, and Framiro, they're a local Zimbabwe local investor group. Even though we operate in Zimbabwe, which is challenging, we take our environmental, social, and governance responsibilities very seriously indeed. So we've got a full suite of corporate governance ethics. We take health and safety extremely carefully. We work hard to empower our workers, uplift our workers, and they're also 10% shareholders in the business in Zimbabwe. We've got excellent relations with the community, which is often a problem for producing gold mines in Africa. The community owns 10% of the mine, and we're very proud of that. We believe that we adhere to very high environmental standards. Shortly, hopefully the next sort of few weeks, we'll be publishing our inaugural ESG report, which should hopefully will provide more context on all of those. COVID had no effect on production last year, but it did have a small effect on the capital project, the central shaft, and that's because the very small group of South African contractors at the mine, when Zimbabwe locked down in March, half of them decided to return back to South Africa. And actually, my feeling really is that it's the half who remained in Zimbabwe for an indeterminate period of time. I think they were the ones who probably wanted their heads looked at. But that did delay the progress on sinking the shaft, which had some knock-on effects. And also, because we were unable to send as many people underground as we would ordinarily have done, they had to focus on production, and they weren't able to do the development that was needed. So that meant that the central shaft was delayed by about 5 months, and so we commissioned it in late March instead of October as expected. We did procure and pay for vaccines for all of our workers at the mine and their families. So that's 1,600 workers plus wives. So that's about 3,500 people. We paid for them. They were delivered. The take up was very disappointing. I think only about 220 people actually wanted to get the vaccines, and so they had to go somewhere else. The ones that were unused, we couldn't hold on to, and they had to go somewhere else. We are still trying to get our workers vaccinated. We're running a campaign to encourage them to do it. But now we're in a situation, having lost the vaccines that we procured, if people come forwards, they now have to wait for the deliveries coming into Zimbabwe, which is clearly very, very slow. But it's a disappointing outcome, but we did our best. We supported the community. This is a clinic that an isolation clinic that we constructed for the community. Cost about $460,000. The biggest operational issue we face in Zim is unstable and lack of power. So we suffer from power outages and also very, very substantial voltage surges. So we do have a full suite of standby diesel gensets, but they're somewhat expensive, although we can digest that. They clearly have an adverse environmental footprint, and logistically it is challenging getting large amounts of diesel at short notice. So we've just embarked on our first phase of a solar project, which will give us about 27% of our average daily usage. And that should be operational by the end of the first quarter, perhaps early quarter 2 next year. But that's a step in the right direction. And also whilst it ticks the green box, it saves us money. So it's good, and it's good in every respect. So this is a central shaft, which is the main thing we've been focusing on. So it's a 6-meter diameter, 4-compartment shaft, very similar to the sorts of things you would see in those big gold mines in South Africa. Commissioning was completed in the end of March, going down to 1,200 meters. And the idea is that this shaft will now give us access to ore below 750 meters, which was previously the lower limit of our mining operations. And that secures our mine life out to 2034. and also gives us the potential to do further deep level exploration. So we're optimistic that mine life can be extended further. We spent about $67 million on that since January 2015, all funded internally through our own cash flow. So as well as paying a dividend, we're also investing quite heavily to grow this. So this is a long section of the mining area. It's about 3 kilometers from left to right. We exploit a series of about half a dozen near vertical ore bodies. The dark line at 22 level, that's at 750 meters. That was the previous bottom of the mining operations. And you can see that all the gray stuff above it, those are the areas that have been worked out. So this mine's been running since 1907. So not surprisingly, it's now got a lot of voids. This was the infrastructure in green that we inherited when we bought the thing from Kinross. So it's a shaft that goes down the right-hand side and horizontal development in 3 directions. But you can see that's now largely giving access to areas where there's very limited resource. So the central shaft is what we put down the middle, down to 1,200 meters, and horizontal development in 2 directions on 3 levels, which opens up access to these deeper level ore bodies, as I've just outlined here. As I mentioned, we're looking at some new things in Zimbabwe. Zimbabwe is interesting in that it until the 80s it was Africa's 3rd largest gold producer, behind South Africa and Ghana. And since then, for obvious reasons, there's been very little, virtually no exploration in country. So it is highly prospective, and we're quite excited about some of the assets and some of the opportunities that exist there. So late last year, we acquired an option over a property called Connemara North. That gives us 18 months to go drilling. We paid about $300,000 for the option to get the option right, and then if we decide to exercise the option, it'll be a further $5 million payable in cash or shares and a 1% NSR. That was the Connemara North asset was previously a part of a package owned by First Quantum, which they sold in 2003. And at the moment, because there is quite a lot of existing geological data, we don't actually need to drill here right now. Drilling will probably start, I'd have thought, in the next few weeks. We've been able to keep ourselves busy for several months by evaluating the old information. And the second one is a property called Glen Hume, which is relatively close to Connemara. And again, similar structure, option arrangement. This time we had 15 months. The total consideration is about 5 million again, but this time it was split 50-50, 2.5 million up front and 2.5 million later on. And we're already drilling there. We take CSR seriously. We build our CSR on the pillars of education, health, agriculture, environment, and women and youth empowerment. But as I've mentioned, we'll be publishing our inaugural CSR report shortly, which will provide more information on that. So by way of outlook, we are looking at an increase in production to 80,000 ounces. That will significantly boost our cash flow, higher production, lower costs. We're targeting an all-in sustaining cost of somewhere between $700 and $800 an ounce, and clearly falling capex. Historically, we've been spending about $20 to $22 million a year. That will fall away quite quickly. So our free cash flow should increase very significantly. And what we'll do with that cash, we've been very clear. We intend to share some of that incremental cash flow with shareholders, and you can see we've demonstrated our commitment to that by increasing our dividend, but also keep some cash back to invest in new projects, particularly Glen Hume and Connemara North, but there's 2 others that we're also chasing. And actually, we'll look at stuff outside Zim as well if they're niche opportunities that we think where we can add value. And I think that's pretty much it. There is some old research available from WH Ireland in the UK, and we do owe WH Ireland we should get together with them and actually refresh that research report. We've been holding on for various bits of information, but I think we're in a position now where hopefully WH Ireland should be able to update that research note in the next few weeks. So I think that's all from me. I mean, I'm happy to take this over to questions.
Okay, Mark, that was very concise. Thank you very much indeed. What's your dividend policy? Let me start by saying you've just increased your dividend by for the 6th time. What's your dividend policy, and how do you expect to sustain it? And are you worried that with all the things that go on in the gold mining world that for some reason or other you won't be able to sustain it?
Well, the dividend policy is to pay a dividend. So which is simple. On the board, about a year or so ago, we took Nick Clark onto our board. He was previously the chief executive, is now the chairman of Camel, which I think some of you may be aware of. And he's clearly, he articulates this view very clearly. Camel had a dividend policy, which was whereby the payout was referenced to as a formula basis, and you had the ability to calculate. And so even though in terms of the Camel, even though in terms of the calculation, you could see that because the copper price fell, the dividend was going to fall, even though it was as plain as day what was going to happen. When the dividend fell in terms of the formula, there was wailing and shrieking from the rooftops. So our view is very much we want to keep the dividend. We never want to cut the dividend. We want to keep the dividend going up or keep it stable. We don't want to cut the dividend. Okay.
Is it popular with both retail and institutional holders?
Yeah, they're all the same. All the same. Oh, sorry, you mean shrieking from the rooftops from institutional, or was that the question?
Well, yeah, I suppose it was. Is there a difference between retail and institutional holders? Do the institutions hold you for the dividend, for example?
Well, we have very few. We have very few institutional shareholders. So our only institutional shareholder of note is Alan Gray, who actually don't give a fig about the dividend. They're in there for the value uplift. So, but we know that retail investors do like the dividend. And look, I'm a shareholder too, and I like the dividend. So our approach is very much to be very cautious and very conservative in growing the dividend, so that we don't over distribute and put ourselves in a position where we might have to, for whatever reason, cut the dividend. And so let's put some numbers on the table. The dividend currently costs about $6 million a year. So $1.5 million a quarter, all right? When we're producing, you could do the maths yourself, it's quite easy, 80,000 ounces, pick a gold price with an all-in sustaining cost of, call it, it's even $800 an ounce. The cash that, and you say tax it at 25%, the cash that comes out of this business, it's north of $30 million a year, $30 to $40 million a year. So in that context, 6 million is barely touching the sides. So we're certainly not over distributing, and we have plenty of capacity to continue to increase the dividend and, as I say, hold money back for strategic purposes.
Okay, so currently the gold price is roughly $1,700 an ounce. Does that mean you're actually throwing off cash at the moment? That means does that make you very, very profitable?
We've been very, very profitable for very many quarters. Yes, very, very profitable. Yeah, I mean, our EBITDA margin is sort of well over 40%.
And where do you expect the gold price to go?
I expect it will go up, actually, but we don't run the business on that basis. So we're very concerned. I expect that with inflationary outlook and geopolitical uncertainty, I think the gold price will at least hold steady and may actually increase. But what we don't want, we spend quite a lot of time marketing in Germany and Switzerland, and you quite often get these Swiss investors who say, "Oh, gold's going to go to $4,000 or $5,000." And actually, that scares the hell out of me. Imagine what the world would be like, what the collateral damage to other businesses if the situation has got to the point where gold goes to that level. So I think we're happy with it where it is. If it wants to go to 2,000, that's fine. But we don't run this business on the basis it's going to go to 2,500.
Okay, very good answer. Michael Whittaker asks, how much of Caledonia's US gold sales must be currently converted into and held in Zim dollars? I've heard there may be changes in the near future. If so, what are the implications for the company? What's the current withholding tax rate? And have there been difficulties recently taking money out of Zimbabwe?
Okay, there's 3 questions there. So currently,
I know he's the devil, isn't he?
It is. Currently, we receive 60% of our revenues in US dollars and 40% in Zim dollars. We use those Zim dollars locally to pay our workers. So we pay our workers on a 60-40 basis. We pay our tax on a 60-40 basis. We pay electricity on a 60-40 basis, and we actually pay a lot of local suppliers on a 100% local currency basis. So far, we've not had difficulty with accumulating money in country, but I think that the lesson we've learned from Zimbabwe since we bought this thing in 2006 is the regime and the regulations keep on changing sort of very quickly, and I'm afraid we've demonstrated over the last sort of decade or so that we're very fleet of foot in terms of reacting to changes as they come. So that kind of moves on to the next question, which is, the next part of the question is, yes, there are proposed changes. In particular, the proposed changes are that we would, when you increase production, you will get 80% of the incremental production in US dollars and 20% in local currency, but still 60-40 for the base level. And to take it further, if you were then to procure a listing on this new exchange, the Victoria Falls Exchange, you would then get 100% of the uplift in US dollars and still get 60% of the base level in local you get 60-40 for still the base level. So if we were to get a VIC4's listing, and frankly I can't see any reason why we wouldn't, that would then move our overall revenue split to 70-30, which is more than comfortable.
Okay. Are you ready for this?
There was one more. There was one withholding tax.
3 parts.
There was actually 4 parts. Withholding tax. It's not significant. It's about, I think it's 5% for distributions up to the UK. It's 10% for distributions elsewhere. So we route our dividends through the UK. And then the last bit was getting money out. No, we actually don't have difficulty getting money out of the country. We did have difficulty being paid for our gold in the first part of Q1, and I did see a question about that. Yes. And our response to that was simply to stop delivering, which meant that when they started paying us again, we then locked up an awful lot of gold, and they just weren't able to digest. They didn't have the working capital to digest a large gold delivery quickly, which meant at the end of Q1 there was a big receivable that worked its way through the system in April. And since then, the payment mechanism has improved enormously.
Mark, you have a brain the size of a planet. I'm most impressed. So, okay, let's move on to Nathan Peters. Do you think there will be more volume in Caledonia Mining shares on AIM if you split your share capital? The current high trading price of £9 to £10 per share probably deters many traders, investors in the market. Do you have a view on that one?
Well, trading on AIM sometimes might be 500 shares a day. Trading this today in New York was 250,000. AIM has got a long way to go, and I can't believe that splitting our shares is going to make the difference. And don't forget, we have to maintain a share price of over $5 so that we don't count as a penny stock in the US. And I'm afraid the main market for trading our shares is now the US by a country mile.
Okay.
So the answer to that, I'm afraid, is no.
Very good. Very good. Do you want to take any more questions from me, or should we wrap it up there, Mark?
No, it's up to you. It's up to you entirely. It's up to you.
Fantastic. I'm interested in my last question then. Would you consider looking at assets outside of Zimbabwe? You've mentioned that Zim is quite a difficult country to operate in. Presumably you mean politically. Would you look at assets outside of Zimbabwe?
Yes, we disclosed that whilst our focus is in Zimbabwe, we will look at assets in niche jurisdictions outside Zimbabwe where we feel we can make a difference, where we feel we can add value to an asset. But we're certainly, and I'm not going to start playing 20 questions of where will you go, but we're very, very cautious about moving into jurisdictions that overstretch the management team. So, if you're buying stuff in the States, it takes 2 nights to get back from the United States to South Africa, which is where our management team is really situated. So within reason, yes, we will, and we do look at things outside Zimbabwe, yeah.
And do you have sufficient expertise in-house to be able to cope with exploration and so on? I know you've got Glen Hume and Connemara North. Are you using local contractors? How does that work? Yeah,
we're using local contractors, but we can easily scale that up. And absolutely, if we get our hands on more assets, we will have to increase our capacity in that area. But you've already spoken to, the company that was on before. I mean, they had a joint venture relationship with some people who got much bigger muscles than we do. And I guess we could probably do the same thing.
Okay, completely fantastic. Mark Learmonth, thank you so much for joining us. That's the CFO from Caledonia Mining Corporation. Absolutely fascinating. Thank you so much indeed.
Thank you very much. Thank you.
And we shall take a deep breath and move on to Tekcapital. Fantastic. Okay, so if you could start to share your slides with us, please, Cliff. Next to present is Tekcapital's CEO, Dr. Clifford Gross. 2 months ago, Cliff told us that all 4 of his portfolio companies were making excellent commercial progress, with both Lucid and Celerius already generating revenues. Guidant will have a remote monitoring and control center operational in Florida later this year. And indeed, Belliscura has now been floated and will be manufacturing portable oxygen concentrators by the year end. So it's all happening. Cliff has announced that the remaining portfolio companies, that's Guidant, that's Celerius and Lucid, will also be floated or sold within 2 years. So here to give us the latest on the plan is the man himself, Dr. Clifford Gross.
Oh, thank you, Donald. I hope you've been keeping well.
I am well, thank you. And yourself, Cliff?
Better than average, actually. It's been an early but robust summer. And we're coming off a very successful year, our best year ever.
And how is life treating you in Miami?
Could be worse, could be worse. It's a nice place to hang your hat, although I do miss being in London. But it's been a while since I've been able to do that. But I hope to correct that in the near future and continue sharing my time between the two jurisdictions.
Okay, I shall leave you to your presentation.
Great. I just want to correct one small mention in your intro, is that our goal is obviously to find exits for the companies that we've started and invested in. The first one already being realized in Bellascura, but the other three companies may find exits as floated companies or through trade sales. And our hope is that we're able to manifest those exits over the next 2 years. And we're working diligently to bring that about. So I just wanted to clarify the timelines and the strategy there. What we do is, if anybody is new to the story on right now, is our goal is to transform university discoveries into valuable products that can make a meaningful difference to people's lives. And in general, we believe all good companies have this sort of dual mandate to improve the quality of life of the customers they serve, and of course to generate solid returns on invested capital. And we are inextricably tethered to that dual mandate at Tekcapital. We are building portfolio companies around what we view as compelling, if not disruptive, technologies that we are able to secure from our global network or alliances. And we have built 4 what we believe to be truly compelling technology companies, which I'll go into in a bit. And what separates these companies, we think, from a lot of early stage businesses is that in addition to having prescient intellectual capital, they also are coupled with star power management. Management teams that have proven to be successful in a number of their past endeavors. We also provide technology commercialization services to about 250 universities around the world. And this allows us to not only cover a portion of our operating expenses, but it also keeps our finger on the pulse of new discoveries at these universities. So we think it creates a competitive advantage. And finally, but by no means least, we have a multi-year track record of improving net assets and also improving sales and profitability all over the last 4 years. So the company is performing well from our perspective, and we're very excited about the coming year and subsequent periods. Our most recent financials from 2020 showed a record net assets of about $32.7 million, and we had about just under 10 million in revenue and about 7.7 million to be exact in net income. So it was our best year ever, although a difficult year by any measure due to the obvious circumstances that we all faced. We were thankfully all healthy and able to execute on our business model. Our net assets have obviously increased with the flotation of Bellascura. They've done a terrific job in developing their first commercial product, the Explorer, getting it FDA cleared, which is no small feat, of course, and then completing a successful flotation. And we had, in these net assets that are reported here, we had Bellascura on the books for $2 million. And at current share price, it's worth closer to 14 million. So it was obviously a strong hit out of the park, thanks to Bob Rocker and his capable team. And we're hopeful that down the road, they will also continue with their strong progress. We have built what we believe to be one of the largest networks of university intellectual capital in the world. It covers about 162 countries and more than 4,500 research institutions. And we're able to electronically see, as it were, new intellectual properties that those institutions have developed that are available for sale or license, and as appropriate, cherry pick them for our either existing portfolio companies or for new portfolio companies that we may want to establish. You know, Marcel Proust, in his novel called The Prisoner, published in 1923, he said something which is often quoted, and that is, discovery consists not in finding new lands, but in seeing with new eyes. And I think it's largely true. It's not perfectly true, but it's largely true. You need to have a robust supply if you're looking for diamonds in the rough. But you know, to mitigate adverse selection, but you also need sagacious selection of those properties if you're going to focus on them and invest in them. So you do need sort of a new set of eyes when you're seeing things that others might be seeing. And to help us with that, we have about 60 scientists under contract to us that are able to review any of the properties that we would like them to review, depending upon their sector expertise. So with that being said, these are the 4 companies that we have built, all of them from scratch, from a clean piece of paper. The oldest is Bellascura, which is not very old at all. I think it's about 5 years old, operational for about 4 of those years, which we own 15% of. And they are obviously a medical device company in the respiratory sector, and they're building portable oxygen concentrators and have a pipeline of other interesting oxygen therapy devices. Solaris is a company that owns the patented process for producing the world's, what we believe to be the world's smallest edible salt crystals. And Solaris is gunning to help reduce sodium consumption in the population worldwide, which is the leading risk factor for developing cardiovascular disease, excess sodium consumption, and the leading cause of death in the world. About 17.9 million people die prematurely each year of cardiovascular disease. And we own about 97% of Solaris. Third is Lucid. Lucid is on the mission to upgrade the world's eyewear. And Lucid makes smart glasses, those proper prescription and sunglasses that are enhanced with Bluetooth technology that allow you to take and make calls, talk to Siri, Alexa, or Google Voice, answer requests from your email, listen to music, and you can order an Uber through your glasses. You know, it's pretty neat what you can do with them. I'm wearing them right now, actually, and they are really quite remarkable. And we own 100% of Lucid and about 80% of their US subsidiary called Innovative Eyewear. And Guidant makes software for improving the safety of autonomous vehicles and delivery drones. And we own 100% of the company, and they recently demonstrated their MVP, which showed that they actually have built a quite successful system for the remote monitoring and control of autonomous vehicles and land-based delivery devices. So these are the 4 companies. They're quite, even though they're small in number, they're quite diverse in terms of the sectors that they approach. What they have in common, as per our mission, is if they are successful, and we believe they will be quite successful, if they are successful, they can make a positive impact on the lives of the customers that they serve, as well as producing heady returns on invested capital. Additionally, they have what we believe to be compelling intellectual property, which, if successful, will give them a moat around the products that they're offering to their customers. Of course, intellectual property is a spectrum, and one has to view it, in a brutally objective way, if possible. It can be, quite time limiting because all patents are sort of limited exclusive periods. but we think they have quite good intellectual property. Together, these four companies hold more than 70 patents. And the other thing that these four companies have in common is they address current markets in excess of $1 billion each. So the first company, just briefly, because many of you probably know the company by now, cover Beloscura. It's the third leading cause of death in the world is COPD, and more than 300 million people in the world suffer from it. It's not a curable disease, and over time, many of the people who have COPD need supplemental oxygen to allow them to perform activities of daily living, and they need more of that supplemental oxygen as the disease progresses. So Beloscura has created a wonderful new device that we think is one of the leading portable oxygen concentrators in the world that is modular, that allows you to upgrade the device by changing a filter that's based in the device, and it's a user changeable filter cartridge. So much as you would upgrade memory on a laptop, you could enhance the capacity of the device to deliver higher amounts of oxygen as your disease progresses. And net, what this does is it makes portable oxygen concentrators more affordable. And that means if the device gets into wide-scale distribution, which we believe it will save more lives. And so we're very excited about the potential of Beloscura to make a dent in the COPD treatment market, as well as producing good returns on our invested capital, which it is already demonstrated to have done. Further, because of COVID, many of the people who survive COVID unfortunately have secondary symptoms, one of which is residual lung scarring, which may necessitate supplemental oxygen. So the current market size for portable oxygen concentrators, which we estimated about 1.7 billion this year, is expected to rise to roughly 5 billion by 2026. So it's a relatively infinitely sized market, unfortunately, relative to the size of the company. And we think that there's tremendous growth opportunities for Beloscura to earn a piece of that market and become extremely successful financially over time. So that is our great hope, and we're very pleased at the progress. They recently announced yesterday, they've signed a second distributor in the US, one in the Midwest. They've already signed one on the East Coast. And their goal, obviously, is nationwide distribution and then worldwide exporting of product to other territories. And so it's a very exciting trajectory that the company is on, and it's in a wonderful position from our perspective. We own just a little over 17.1 million shares of Beloscura. Lucid. Lucid makes eyewear. Now, eyewear industry is pretty stodgy. I mean, it was developed, there's an argument, it could be Pisa or Murano, but about 730 years ago. And for the last 400 years, the glasses I'm wearing and the glasses depicted on this slide, the dual temple format, has been the major innovation in eyewear. So over 400 years, the style hasn't changed much. But Lucid is aiming to upgrade the world's eyewear by incorporating into these stylish frames, Bluetooth technology that enables the glasses to seamlessly communicate with your digital life, whether it's a smartphone or a smartwatch or even your PC. So you could exchange information, take and make calls, listen to music, talk to any of the digital assistants. And it's quite a remarkable product. But Lucid is not just interested in incorporating technology into prescription and sunglasses, which they are doing very well. And they introduced their first commercial product in January 2021 of this year. And it's been quite wonderfully received. They have over 200 five-star ratings between Amazon and the lucid.co site. But they're interested in making and selling millions of pairs of smart eyewear all over the world. And to do this, you have to do three things in our view. One, the glasses have to look good. They have to have a designer appeal to them because you're putting them on your face. It's not like wearing a watch. And by the way, talking about watches, the eyeglass market's at least twice the size of the watch market. You know, 2/3 of the population needs corrective lenses, and the other third, for the most part, want sunglasses. So it's really a global population that eyeglasses serve. Second, aside from them looking good, they have to be comfortable, and the proxy for comfort is weight. And traditional glasses weigh about 1 ounce. The Lucid Light line, pun intended, weighs between 1.1 and 1.4 ounces. So they feel like normal light traditional glasses, but they really offer so much more. And the third item that has to be checked off if you want to make and sell millions of pairs of glasses all over the world is they have to be priced like normal glasses. And the MSRP for the Lucid Light glasses, and they have omni-channel pricing, so it's the same whether you buy it from them or buy it through a retail outlet, is $149 for the sunglass format. So Lucid is the first company, in our view, that makes beautiful, smart, lightweight, and favorably priced or aggressively priced glasses that allow you to completely remain connected to your digital life as well as correcting your vision or protecting your eyes from sun exposure. And that is a great achievement in our view.
I could just jump in there, Cliff. So sorry to interrupt. 2 minutes. You have 2 minutes.
Okay. Lucid signed a brand ambassador, Richard Sherman, who was an NFL player and was a Super Bowl champion. It's been very helpful in promulgating the brand. Solaris makes a low sodium salt that's all natural, non-GMO, tastes like salt because it is salt. It's even kosher. And they are seeking to sell it to the major snack food companies. And later this year, they will be introducing packets of microsalt, which is their trademark name, in supermarkets and convenience stores and restaurants throughout the US and then beyond. So we think Solaris is a terrific company with a great management team addressing the #1 cause of death in the world, premature death, cardiovascular disease. The team is headed up by Victor Manzanilla, who was previously at Procter & Gamble, and on his board is Eduardo Suchin, who was the brand manager for Pringles, which is owned by Kellogg's, and also on the board is Steve McCready, who was previously the director of product development for Albertsons, the second largest supermarket chain in the world. Guidant is making software to help improve the safety of autonomous vehicles and delivery devices. Everyone knows autonomous vehicles are coming in numbers and the delivery devices are coming first. However, there will still be accidents, even though these vehicles are run by pretty sophisticated algorithms. And what you need to do in those accidents is a little tricky because often there will not be any driver in the vehicle. And in the case of delivery devices, there will never be a driver in the vehicle. So Guidant is building the first remote monitoring and control center that will be able to virtually jump into a situation and help resolve accidents by calling a first responder or moving the vehicle out of harm's way. Guidant also, as some may recall, has acquired an interesting technology for developing regenerative shock absorbers. And we have been working on that technology, or Guidant has been working on that technology, and they recently completed the engineering design for their new regenerative shock absorbers, and they are now going to be fabricated and tested throughout the summer. The design specification is roughly 100 watts per shock, which would be 400 watts per vehicle, which if the product is able to meet its design specification, it would add roughly 5 miles to the range of an electric vehicle, which is significant. And Guidant has a terrific team headed up by Harold Braun, the former CEO of Siemens Nokia. On his board is Johan Denischen, the current COO of Volkswagen North America. and Daniel Grossman, who was one of the founders of Zipcar and was the COO of Maven, the General Motors mobility company. So in summary, Tekcapital commercializes and transforms university innovation into useful products that can improve people's lives and provide services to a number of universities around the world. We've built in our view, a terrific portfolio of 4 companies that have significant potential energy to achieve market penetration in their respective sectors and proprietary intellectual property and significant leadership experience to help enable those journeys. And finally, we have a multi-year track record of delivering significant growth of net assets, revenue, and profitability. Thank you very much, and I'd be delighted to take any questions you might have.
Okay, Cliff, thank you very much indeed. Yes, we've got a few questions from the audience and a few questions from me. So let me start with one from the audience with a gentleman called Siddharth Bhaskar. A 2-part question. Are you still planning to spin off all 4 companies? Well, one of them, Bellascura, has already been spun off within the next 2 years, i.e. by the end of 2023. And the other part of that question is, how will you pay the shareholders that special dividend? How exactly will that work?
Yeah, well, like any good librarian, the goal is to lend out the books. You don't want to keep the books in the library. So we're building these companies so that they can go out into the world and do what they're supposed to do. And that means that we're building them for either trade sale or flotation. And so, yes, we plan to do that. And that's part and parcel of our reason for developing these companies. Nobody wants to have 40-year-olds in the basement, you know. Yeah, and in terms of the special dividend, our business model is.
No, you haven't answered my question though, there, Clifford. 2 years, 24 months. Do you hope to have all your businesses floated or IPO'd within 24 months?
Or trade sale.
Or trade sale, yes. You can do what you will with them. You can do what you will with your children.
Yes, I would like to see that happen within 24 months, if at all possible.
Fantastic.
It might be sooner for some. The market is pretty frothy here, and we're in quite a prescient area in each of those technologies. So I think it might be quite exciting the next 2 years for our shareholders. And then when we do have an exit, and we are free to monetize, and we think it's an appropriate time to monetize the shares of those exits, or if it's an exit in cash, we will then declare special dividends as we go and as we receive and manifest these exits to return a portion of that upside to our shareholders directly. And that's part and parcel of our business model.
Can we expect 4 exits, 4 special dividends?
Correct. That's the goal. That is the goal.
Fantastic. Okay, that's lovely clarity. Thank you so much. Mike, could we have slide 13 up again, please? That's the what's the name? Regenerative shock absorbers.
Yeah.
Now,
So
you guys are making regenerative shock absorbers for autonomous vehicles. Very innovative. And a gentleman here called it's, with apologies, Panjak Patel. When can we expect the launch of the Florida RMCC, partnership deals, and also update us on the regenerative shock absorber testing?
Got it. The RMCC, the beta version of it is already launched in Boca and has been demonstrated, and a video of it has been released publicly. They are Guidant is seeking to build out this remote monitoring and control center, which is required by law in the state of Florida, and recently in the state of California, and recently throughout Germany for autonomous vehicles. So they're seeking to build out this remote monitoring and control center this year, by the end of this year, and onboard hopefully 1 or more major customers this year. To do that, like all of our portfolio companies, they're pursuing additional financing either through crowd funds or venture or investment banks. And so, and the same is of course true for guidance. So they're in the process of doing that as well. And we believe they're on track to achieving that goal. Additionally, they're not just building a remote monitoring and control center, they're building one with extremely low latency. And that separates the men from the boys, as it were, in terms of remote monitoring, because latency means, by latency, I mean the time it takes a signal to get from the vehicle to the remote monitoring center. The longer that takes, the less efficacious the remote monitoring is, because the vehicle isn't where you think it is by the time you see the signal.
But you guys are pretty good at that.
Sorry?
Your latency is pretty good.
Yeah, thank you very much. Yeah. Latency, for the guidance latency, they haven't published the numbers yet. They're still testing them, but we think they're south of 50 milliseconds, which would be the best in the world. They haven't published the numbers yet. They're still researching it, but they have developed some very interesting technology that specifically is designed to minimize the latency. Yeah, so that's the story. And then in terms of the regenerative shock absorbers,
yeah.
They've finished the engineering design. They've done a really nice job of it, in my reckoning. It's a beautiful technology. It could be really helpful for all EV manufacturers globally. However, they have to still fabricate and test it independently, and that's going on this summer. So again, it's a binary output, and then by that I mean there's no question in our mind that the technology works, but how well it works, of course, is the question, and we won't know that until it's independently tested. If it delivers on spec, and that is 100 watts per shock, which is 400 watts total, for a vehicle that has a 300-mile electric vehicle that has a 300-mile range, these shocks will deliver an extra 5 miles of range, at no trouble to the driver, or and it will continuously do so as long as the car is driving on Class A roads at 60 miles an hour. If the roads are bumpier, it'll deliver more power. If the roads are smoother, which is not a problem in the US, but it might be elsewhere, they'll deliver less power. So we think if it delivers the design specification, it'll be pretty fetching technology for any major electric vehicle manufacturer. So we're very excited about it.
What could the potential market size be, and how many people in the electric car vehicle market do you expect to be interested?
Well, look at it this way. I can't give you a specific number without being disingenuous by accident, but basically all electric vehicles have a regenerative braking. And regenerative braking basically generates electricity from the heat energy that is normally dissipated by braking. The electric motors that power electric vehicles are bidirectional. They work in both directions. And when you step on the accelerator, this sounds a little basic, but I'm just sort of giving you the primer on it. When you step on the accelerator, the power from the battery turns the motor, which turns the wheels, moves the car forward. When you take your foot off the accelerator or step on the brake, basically the reverse happens. The wheels turn the motor and generate electricity, and you could send that to the battery, or you could store it in ultracapacitors. And so you're able to capture electricity from the friction of braking the vehicle, braking the speed of the vehicle. All electric vehicles do that, and the regenerative braking generates, it varies depending upon the driving conditions and the vehicle, et cetera, but it generates roughly 15 miles for a 300-mile charge up. And it's sort of standard fare for the vehicles in extending the range of the vehicles. And we have good advice from car companies in our view that a 5-mile increase from shock absorbers that are otherwise just dissipating the energy as heat and vibration would be a wonderful addition to extending the range. And one of the battlegrounds.
Just wind you up there, Cliff. I'm gonna pop in another question just while we have you on the line. Shivam is a long-term investor in Tekcapital, and he says, "Can Clifford please elaborate on the high-level non-cash items they use to report revenue and earnings? Do you use any assumptions in coming up with those revenues, or are these tangible revenues? And please, can we get a percentage breakdown of the revenue by top 3 holdings for tech?
Yeah, I'll refer him, of course, to our annual report for a detailed discussion on that. But at a high level, the revenues are from 2 sources. They're either from the service revenues of providing services to universities and helping them evaluate or commercialize their IP, or from the unrealized gains or losses in our portfolio companies. We have 4 portfolio companies. We are required under IFRS to value these companies annually and have them audited. And we in fact value them twice a year, even for the review period. And you have to do one of 3 things when you value the companies. If it's a quoted company, you could observe the closing share price at the end of the period, for example, as a good indicator of the value of that company. If it's an unquoted company, you have to do some other things. You either could tie the valuation to a recently conducted arm's length funding of the company, such as if it did a private round at 10p a share, you could say, you believe your shares are also worth 10p. Or if they haven't done that, or if it's more accurate, you can have that company independently valued by a qualified independent valuation company that's approved by your auditors. And that company can put an appraisal on the business, and that becomes the value of the company. So the collection of the 4 values of our portfolio companies is part of the revenue, and the service revenue to our universities is the other part of the revenue. And that's typical for an investment company.
Dr. Clifford Gross, you've been a complete star. Thank you very much for bearing with us. Sadly, we weren't able to get through all our questions. We have lots and lots more for you, but that's it. Time is up. Thank you so much for joining us from Miami today.
No, it's my distinct pleasure. Thank you, Donald.
No, the pleasure was absolutely ours. And finally, we go, last but not least, of course, it's the man from County Cork, Maurice Healy, the CEO of Glantus Holdings. Glantus are a global supplier of automated accounts payable. Accounting software might sound a bit dry, but not when it's Maurice telling the story. Glantus IPO'd and raised 10 million in a placing and a further 4 million in May, and have a market cap of 33 million pounds today. They cover MEA from London, and the States get covered by San Jose. The clients are typically global as in very, very large enterprise businesses, multinationals and the like, with a degree of complexity in their accounting systems, with many suppliers. Growth was expected to come organically and through acquisition. And here's the man himself, Maurice Healy, to tell us all about it.
Hi, Donald. Thank you for having me on here.
It's a pleasure. Are you going to share your slides first of all, Maurice?
Sure. Mike, will I share mine, or do you have a copy, or will I just share mine?
You share yours and we'll give it a go.
Okay, fair enough.
Yeah, you share them, and if you can't make it work, then we'll do it for you.
Okay, no problem.
Yeah, it's working.
It's working, okay. You guys can see that?
Yes, and then if you just go full screen for us.
I'll do that.
Yeah, presentation button, good man.
There we go. Okay, Donald, I'll run through there are a few slides here, but I won't spend a lot of time on many of them, and hopefully leave enough time for your questions at the end. First of all, before I go on, just to give you a couple of the headlines. First of all, we're an Irish headquartered company. We're headquartered in Dublin. Our operation, as you said, we have 2 operation centers, London for EMEA and San Jose for the US. Our revenues to the end of last year were €8.5 million. Before the IPO, we were 85% owned by management. Post the IPO, we're 55% owned by management. We sell our own product, it's all our own IP, and 89% of our revenues are recurring. So that's the headline. We're a tech stock, but we're a very stable tech stock. You spoke that we work in the area of accounts payable, and you know, accounts payable can mean a lot of things to a lot of people. We work with the accounts payable departments of large organizations, large enterprises, global enterprises. And we define our market when we're looking at qualifying customers. We just ask two questions: what is your spend, and how many suppliers do you have? We tend to work with companies with a spend greater than 500 million sterling, and they tend to have suppliers in anything from 4,000 suppliers up to 120,000 suppliers. And we work with these organizations because no matter how sophisticated their ERP system is, they have leakage. They have difficulty getting control of their supplier ecosystem, and they lose a lot of money in terms of duplicate payments, credits not processed, contracts not being complied with. So lots of different areas. And the reason this is happening is that the organizations we deal with have multiple regions, multiple divisions, ERP systems, instances of ERP systems. And a lot of them have grown by acquisition. And so they have multiple companies, even within regions. So the bigger they get, the more complex the whole area of accounts payable becomes for these organizations. And because they can have a supplier and multiple instances on multiple systems, then credit notes are not processed properly, payments can be duplicated. And as I said, the bigger they get and the more geographically spread they get, then you've got situations where contracts that they've made a global agreement with in London are not being complied with in Africa or in Australia. And so we step in and we've created and developed our own IP. It's the Glantus platform. And we have three modules to it effectively. The first is the discovery. We talk about discovery and recovery. So we sit in the cloud above all of their systems, and we extract data from those systems, all their AP data, and we bring it to one place and we make it manageable. And we look for anomalies. So you have a situation where they've received statements, or clients have received those statements, and as I said, it could be anything from 4,000 to 120,000 statements, in some cases multiple statements from the same supplier, and we check it against what's on their system. And that's where we find the anomalies. So the first thing we do with them is we recover lost working capital. So it's an instant return on investment. The second thing we do is we automate the processes. Our system is real time in the cloud. So we basically have a button on whether it's the CFO, the head of shared services, whoever it might be within the organization who heads up that AP function. They can design their own reports, but they can run a report and find these anomalies. So that automation prevents the kind of losses they had. And the final part is the analytics piece. And with the analytics, we're bringing all of their data on their suppliers together in one place. They can analyze it and they can use it to forecast. So from a customer's perspective, when we're in talking to a customer, they recognize these issues. They recognize the problems. So they know we can recover their working cap. So that's cash for them. We make their departments run more efficiently. So they save a lot of time and money in that. And then using the analytics piece, they finally have control of their ecosystem. And they can, it saves them a lot of money, but it also helps them predict things as they go forward. You've mentioned this, and I've mentioned it as well. I won't spend long on the ISO, but we run by standards. When we're dealing with these large organizations, we're often writing into their systems, extracting data from their systems. And you can't do that unless you have the highest certification. The most recent one, 27701, we're one of the few companies in the world to have that. It's a recent system around privacy, and that's becoming a bigger and bigger issue for our clients. The market is growing. So What fuels our market is economic activity. So we're right now in a situation where we're coming out of COVID, a lot of activity going on. The economies are growing, our customers are growing, and every time there's some M&A activity, well, that feeds our system. So we're now in EMEA and in the States, there's a lot more M&A activity, which means that all the problems I outlined earlier are compounded. So you've got a situation where multiple systems, multiple companies, the more M&A activity there is, the more there is a need for our solution. Briefly on this, a company, multinational, recently won 10 billion more spend, set up a shared services for their AP team, but they couldn't get control of all of their data. The color coded there, it's blurred out to protect the privacy of the company. But those color schemes, that's the number of systems they had. Every color represents a system. So they had no control over their master data, and they had no visibility of the contract or the performance of those contracts. So we've gone in, they've signed up with us. We're giving them master data that they can work with. And throughout the process with them, we're doing the recovery, we'll be doing the automation, and we'll take them right through to the automation. But you can see the complexity that these companies are dealing with. We work in all sectors. That's the difference with the slides I hadn't put up. We have large organizations, global organizations, the likes of Diageo, EasyJet, Interflora. In the States, we've got Grainger, Graybar, multiple organizations and lots of different sectors that we work with. We have 3 areas of growth in the organization. So we have organic growth, and that has 2 forms. We have an existing customer base at the moment of 55 of these global organizations. And we have to take them on the journey. We're doing different things. Sometimes we're doing a purchase to payment automation system. Sometimes we're doing a recovery piece for them. One of the reasons that we raised money was to invest in the whole area of account management, because we didn't, a lot of what happened to us, a lot of the interest, I won't lie, took us a little bit by surprise. So we're playing a bit of catch up on the marketing and the account management. We've been hiring since we've done our IPO, and we have a lot of customers needing to talk to us, wanting to talk to us, these global organizations, and we'll be taking them on the journey and increasing our revenue per customer. And then the second part is the whole area of new logos and new brands. And again, our pipeline has grown considerably since the start of the year, particularly in the States, as we have, I suppose, through what we did in COVID, digital marketing, going to online events, the solution has gotten a bit of traction within our sector. And so we have a lot more inbound. So organic growth is going to be very strong. An area that's new to us, one I wasn't too sure of myself at the beginning of it, because I don't want to be a partner where I'm one of 12 widgets someone is selling. But we're now in a much stronger position with partners, because we have found the kind of partners we want. We're looking at partners where we are an integral part of their strategic growth. So a recent partnership that we've had would have been with the URA in Michigan, where they sell into our profile of customer, and they do recovery for them, but only in terms of utility payments. So they needed to expand their offering. We wanted access to their customer base, perfect partnership. We're doing the same with other organizations, some who just do tax with these customers, and we go in and we expand it. And there are others who are OEMing the product. So partnership is another strong area of growth for us. And then the final part is that of acquisitions. We have a track record of doing acquisitions. We're good at acquisitions. We're good at finding them. We're good at negotiating them, and we're good at integrating them. And we have very strict criteria for doing acquisitions. We acquire companies that are, first of all, operating with our profile of customer. They have to be working in our sector with the finance function of these large organizations. We look for them to have good, strong recurring revenue, a good spread of customer base. And we also look at how we can add value. And I'll explain how we did that with one acquisition shortly. We have a good Glantus has a good track record of delivering strong financial growth. As I said, we're a tech company, and I'm speaking to you from the States at the minute, and over here, a tech company that is profitable with strong EBIT and strong growth is an unusual thing. One person over here said, I'm not sure how to deal with you, but that's the stability of our business and the recurring revenue that we have generated over the past while. These are between the subscription and the transactional recurring revenues. That's been the growth and revenue profile that we've had over the last 3 or 4 years. You've noticed I'm flying through these ones mainly because the CFO normally does these slides. So, but here is an example of an acquisition we did last year, JPD in San Jose. It wasn't making any money. We paid $4.5 million for it, spread out. And within when we started to apply our automation to this business, we reduced the headcount from 65 to 35, and we took it from a loss-making situation to profitable to the tune of $1.5 million, 700,000 of which was recognized last year, but on a run rate basis will be $1.5 million. Another thing to point out is our R&D. We do continue to invest in R&D. We've put $2 million in over the last 2 to 3 years. We capitalize it over 3 years. Our annual budget in R&D is about $1 million. 500,000 of that is kind of upkeep and maintaining the systems and doing run-of-the-mill work on it, and 500 is a discretionary spend that we have in improving or putting in new features or adding to the platform. On the why invest, I won't even do that. I'm going to stop sharing here. I'll just give you 4 reasons why people should invest. First of all, I'll give you a reason you shouldn't invest. We're going to be a very busy company. If you don't like very busy companies, we're not the company for you. But the reason one should invest with us is that we're a tech stock, but we're a very stable tech stock with 89% of our revenues recurring. The market we're in is exciting, and it's a consolidating market, and it's very attractive to equity houses. There are a few gorillas in there. So we are very much building to scale, knowing what our market is over there. Third thing is we own our own IP, so we control everything ourselves. And finally, our growth strategy, apart from saying, you know, we have an amazing product, it's right for the market that we're in, it's a proven product. But we run our business, 55%, remember, is still owned by management. And we have a clear strategy of how we're going to grow shareholder value. Not just the growth, our margins will grow, but we're looking at the arbitrage between what we are acquiring companies for and our own organic growth and what the US market in particular does. So we're acquiring companies anything from 5 to 7 times EBITDA or 2 times revenue. And when you reach scale and you get to scale, then over here in the States, it's like 18 to 30 times EBITDA and 5, 6, 7 times revenue. And the characteristics to get that are the fact that it's our own IP, the fact that we're profitable and in control, and every time we grow our recurring revenues, we grow our margins. And what we require now is to reach that scale. And that's what we're working on. We're very focused on it. We're very focused on the metrics of any acquisition we will do. But that is our intention. It's to hit those high multiples and valuations over the next couple of years through growth and through scale. And I leave it at that, Donald, and open it up to your questions or questions from anyone else. I think I stayed within the timelines.
I think you did. I think you were amazing, to be honest. You've got such an interesting business model. It really is absolutely fascinating, Maurice.
Thanks, Donald.
No, you're to be commended. It is so interesting. Let's go for some random Q&As, and then we'll get into my sensible ones. Random Q&A from Paul Sapsford. Do you take a percentage of the saving detected?
Yeah, so we have two types on the recovery. Some we do a fixed price with, and others we take a percentage. The percentage can vary with the scale of the company, anything from 15% of the recovery up to 30%. We average out about 17 or 18%.
So you've got some skin in the game when you save them money.
Oh, absolutely.
Wow, that's clever. Mark Joe, or that could be Joe Mark. It's difficult to know which way round. What percentage of revenue does your largest client contribute? Always a good question. And are revenues equally spread or tilted more to a few larger contracts? In other words, is there a degree of risk built into the business because you've only got a few really big clients?
Yeah, no, it's pretty well spread. I would say, and I can be corrected on this, but I'll only be out by a small margin if I am. The largest customer in our revenues for last year is probably between 300 or 400 grand. So that would be, 3 or 4% would have been the largest customer last year. So there's a good spread across the customer base. Okay,
what would your typical margin be on one of those larger customers? Is that a tricky one for you, or can you have a go at that?
No, it's not a tricky one. I guess first of all, from the point of view of being all our own IP, or every time we sell a subscription revenue, then our margin is about 90% on any subscriptions we sell. The recurring revenue is probably around 55 to 60% because we load in a lot of the costs in. I'm answering that question, Donald, by thinking of the commissions we pay our salespeople. So we typically pay on a gross margin of anything. So when it's a subscription-based thing, we pay on 90%, and when it's a transactional, we pay about 60%.
And how would you hope to grow those margins, or is it pretty full already?
No, not at all. Well, the 90%, the growth in that is all on the recurring revenue for the bottom line margin, the EBITDA margin. So over the last couple of years, we've gone something like 22% to 26% to 28%. We expect to be 30% or more on an ongoing basis at the moment, and we'll continue to grow that margin the more you grow the subscription revenue. The other thing that's happening, and when I give those margins that I gave on the transactional revenues, the technology, we've been developing the technology into that space. As I said, we went with the JPD acquisition from 65 staff to 35 staff. But actually the automation across the rest of that business, we've been developing over the past while. So the margins, even on the transactional stuff, more and more is being done by the technology. So the margins on that are growing all the time.
Great. Who do you see as your competitors in the marketplace? You've got Microsoft at one end, you've got account providers in the UK like Sage at the other. So where do you fit into all that? And are they all your competitors?
Or are they all our partners? It's an interesting one. So when you look at ERP vendors, and they all have a bit of what we do in their system. So they'll have some analytics, but they're fixed in their own ERP system. So they can't bring other products into that, other systems, or it's a HR system, CRM system. And also, as I say, when they grow, they tend to have more than one type of system. And even when they have just, put in a whole new, one of our customers 3 years ago put SAP across the entire group, and they still need our requirements to fix up those anomalies that I talked about. So we tend to have competitors in each of our areas. So there will be people who work on AP automation. There will be people who work on analytics or recovery. And what the reason we win, if we're brought in on an analytics project, some AP guys, they ask us to come in and we'll be competing with other people who do analytics. Then we tend to win because when we're showing them what we're doing, we're bringing them in through the Glantus portal. So they're seeing the other products and we're talking with them saying, this is what we do in the analytics. And by the way, this is what we do in recovery and this is what we do in automation. And so it's the context of the journey that we can take them on that tends to win us the business when we're in a competitive environment. And then to get back to what you were talking about, whether it's Sage or SAP or Microsoft Dynamics, then that's not an issue for us. We extract from all systems. We have APIs into all of those systems. So oftentimes we'll be brought in by one of these resellers, a reseller of SAP, a reseller of Sage, a reseller of Microsoft, and we'll go in alongside them and we'll provide our additional services to tidy up the supplier ecosystem.
Fantastic. Okay, that's a really interesting answer. Here we go. Mark, Joe, how has trading been since listing?
So we're in a closed period, or obviously our H1 ended at the end of June. So I'm sure I'd be forgiven if I'm not giving too explicit an answer. So I
You're
suppose
forgiven.
we haven't issued any negative notifications. So I guess that's about as much I can say on that right now.
Okay. Mohit Gadri asks quite a detailed question, but an interesting one nonetheless. At 31st December 2020, there were 6 million of bank loans. Has the IPO paid down the debt? What headroom is there? And can you provide an overview of your covenants?
Sure. So you're absolutely right. It's 5.2 and there's an exit fee of 800,000 on that. We raised 10 million sterling. So, and by the way, the interest rate on that is 12%, and we've been working with this banker for 4 years, since 2017. So the only thing I'll tell you about that, that's how strong our cash generation has been, that we were able to handle all of that. Your first question, have we paid down the debt? No, that is not our intention to pay that debt down right now. We have a lot of plans across the acquisition, the partnerships and things like that. We have a big focus on the States at the moment. The funding situation in the States is a lot cheaper and a lot bigger than it is back home. And we are working with financial houses over here, and we will refinance our debt in its entirety. And depending on what we're doing with acquisitions and such, we may refinance it in a bit of a larger scale. But even if we're doing that, well, we will be doing that. We will refinance. That's a certainty, and we'll be refinancing at a much cheaper level. But we won't, as an organization, we've been conservative all the way along. We haven't done anything crazy. We don't have a burn rate. We've always had to make money. That's how we survive. And as we grow by acquisitions and that, we don't intend that our EBITDA to debt will ever be more than 2x.
Okay, my final question, Chimoris. You've been very patient with me so far. Organic growth versus acquisition. So what's the organic growth that you can squeeze from the business? Because I know you've got lots of recurring revenues, as you've told us, a really, really high percentage, 83% or something. So where's the organic growth going to take you next year, for example? Or do you have a run rate for that? Can you explain how that's going to build in future years? And then I'll come back to acquisitions as my final.
Yeah, so organically, we expect to be growing. We didn't factor in partnerships into this. We're testing the water on that. We've got a few coming up. So
it's going well, though. Partnerships are going well.
Partnerships are going well. We're signing them up. We still have to see the evidence of what they're driving in revenues. The forecasts look strong, but you know yourself, until you see the money, it isn't there. So leaving that aside, our organic growth is between 25-30% on the core business. On top of that will be layered the success we'll have with the partnerships and then the acquisitions on top of that.
But acquisitions seem to do so well for you. So how many typical acquisitions do you think there are out there in your sphere?
It's a very exciting part of it, of our story. The market we work in is ripe for consolidation right now. So we would have a pipeline at any time of acquisitions that we're looking at, and there's no shortage of them, Donald. We'd eliminate, 90% on the first pass. Often it's just the person you're talking to, and there's no way I'll ever get a deal done with this person. I'm not going to waste my time. We look at the profiles of the acquisitions, but there's no shortage of it. And we, particularly as we look at the States, but in EMEA as well, there is that consolidation place. So our ambition as a management team, and this is no forecast, but our ambition as a management team over the next 18 to 24 months is between all those areas of growth to get to a run rate of about $50 million revenue.
That's a lot. And so how many acquisitions could you hope to do per year over that time frame, do you think?
I reckon that every year there'll be a minimum of 2, possibly 3 acquisitions. And the acquisitions, Donald, in the way we're looking at it, we'll have similar acquisitions, I think, in the short term to the likes of JPD that we did. And every time we layer on that scale, then the acquisitions will become larger. That's our intention, that's our plan. And as I said, we have a decent pipeline. With what we raised and what we can do at the moment in short-term debt, as I said, a big part of what we're doing is maintaining those metrics of 2x post synergies in EBITDA to debt. And I think that's all very achievable for what we have in front of us at the moment.
Okay, very briefly, Anthony Collins says, this is my very, very last question. On which exchanges are you quoted? I think you quoted an AIM. What else are you quoted on?
That's it, just AIM.
Fantastic. Okay, Maurice, you've given a complete star. Thank you so much for joining us tonight. That's it. You can get off to the Italy-Spain match now.
Here we go.
With a pint in your hand, Maurice.
You know I wouldn't touch the stuff, Donald.
Oh, I know you wouldn't, Maurice. I can tell you that kind of chap. Enjoy yourself.
Thank you very much. Thanks for having me.
It's been a pleasure. I'd just like to say a very big thank you to all our companies for being with us tonight. You've all been complete stars. I'm extremely grateful to all their teams for getting us there, because I know there are always many people involved in getting companies and not just the CEOs in front of investors. And with a special mention to Brad for getting up in the middle of the night. He is a star. Thank you so much, Brad. By Wednesday evening, we should have released videos of all 4 company presentations, and not forgetting that you can subscribe to the London South East YouTube channel and receive alerts for all our IR videos. So you will see those there from Wednesday afternoon. And by the end of the week, we'll actually put a package together and send you copies of all the company slide packs and videos in one useful email. So you can look out for that. And of course, looking ahead, we'll be doing this all over again after the summer. We're offering our holidays in August. I hope that you're going to have a good holiday here in the UK or even abroad if you're brave enough. And we'll see you again on Tuesday, the 7th of September. That's our first event back. Then we've got Tuesday, the 19th of October. Tuesday, the 7th of December is our final event of the year. And if you want to check out where those are, just look at the events tab on the London South East website. Thank you so much for joining us tonight. It's been a really fantastic evening. We've had some great presentations. I thoroughly enjoyed them all different in their own different ways, as they always are. And I hope you've already made it to the London South East company chat boards to tell people what they missed out on. There's certainly plenty to talk about. So a huge thanks again for being such a great audience and staying with us to the end. We're very grateful, truly very grateful for your time. And off you go. You can join Maurice with a beer in your hand and go and watch the Italy-Spain semi-finals of the Euros now. You've done well. You've done the business of the day. Now you can go and have some fun. Good night, and may all your investments go well. Thank you.